You've probably heard people call ICT a scammer. And if you've spent any time on trading Twitter or YouTube, you know the ICT debate. Half the community swears by his concepts and the other half calls him a fraud. But here on YouTube, for all the arguing, for all the strong opinions, there hasn't been many proper backtests by experienced traders. So I decided to do a backtest of the Judas Swing to see whether this ICT strategy gives traders an edge, or if it's just a shortcut to losing money. The question I'm asking today isn't whether ICT is a good trader, but whether you can systematically profit from his specific concepts. And the results may surprise a lot of people. But first, what is the Judas Swing? Let's make sure we're all on the same page about what we're testing. The Judas Swing, according to ICT, is when the market creates a false move in one direction during the London session, then reverses to take out the opposite side of the liquidity. The idea is that smart money uses these false moves to trap retail traders before moving in the intended direction. You're supposed to wait for the reversal of the trade with the smart money, not against it. Now, ICT teaches this as part of a broader market structure approach. He emphasizes that you need to understand the higher time frame bias and only trade these setups when they align with the overall market direction. But here's what I wanted to test. If you strip away all the subjective analysis and focus on the core mechanical setup, does the Judas Swing actually provide a statistical edge? Part 2, the setup. Now let me walk you through exactly how we tested this, because the methodology is everything. If you don't test it properly, the results are going to be worthless. We tested Great British Pound, USD and Euro USD over the past 50 trading days. These pairs are major pairs with high liquidity and strong price movement during the London session, where ICT claims these setups work best. We focused specifically on what ICT calls the London kill zone, a fancy term that describes a specific window during London trading when major price moves and liquidity grabs supposedly happen. Then we define the liquidity pool by simply marking the high and low of the Asian session in the hours before the London opened. Then we set our Judas Swing conditions. The initial move had to break the Asian range by at least 10 pips. After that breakout, we looked for the liquidity grab, price sweeping either the Asian high or low. Once we got the sweep, we waited for what ICT calls a market structure shift to confirm the reversal. I used a simplified version where I looked at the market structure shift on the same time frame using my own similar model. ICT recommends going to a lower time frame, which intuitively I think would improve the results. The stop loss was placed 10 pips beyond the Judas high or low. Take profit at the opposite side of the Asian range, and I added a few extra rules to keep things realistic. No trade if the sweep went too far, no late entries, and close everything at the end of London. This isn't a perfect test, since the method relies heavily on discretion and can't be fully captured in a rigid backtest. It really needs to be live traded over time. But as an experienced trader, I can give you a fair and realistic assessment. Think of it more like, how would an experienced trader approach this setup in the real world? And here's what happened when we actually ran the numbers, the results. And here's where it gets interesting. Let me show you the actual numbers. And we've formatted the data in R multiples, meaning if you risk $1,000 per trade, -1 R loss equals -$1,000, and a 1.5 R win equals $1,500. Looking at Euro USD first, we had 12 winning trades, 8 losing trades, and 2 break-even trades out of 50 trading days. Interestingly, there were only 23 actual trading days where setups occurred. That's less than half. The win rate was decent at 52%, but the expectancy was pretty low at 0.28 R per trade, but still not bad for the framework. If you followed the strategy exactly as we tested, you'd have ended up with a plus 6.5 R total profit. And that's going to be enough for most traders to achieve their goals if they position size correctly. Note that a lot of the time there was no trade, only about half the time. But what about the Great British Pound USD results? Well, we had 13 winners, 9 losers, and 0 break-even trades. We had a higher win rate at 59%, better risk reward at 1.6 to 1, and much better expectancy at 0.5 R per trade. That's almost double the Euro USD expectancy, and it's sort of what you're looking for a consistent trading strategy. So it looks good on paper, but the question becomes, is this actually practical for real trading? Let's discuss the data instead of just looking at the raw numbers. What this actually means now. The numbers only tell part of the story, but the fact that this was profitable at all puts it ahead of most retail trading strategies. You've probably seen the statistics. Most retail traders lose money. So any edge, even a small one, is significant. Another thing is that the setup only appeared on 22 to 23 days out of 50. This means you're sitting on your hands more than half the time, waiting for the perfect setup conditions. But this is fine. Patience is rewarded in trading, and you can trade the strategy across multiple markets to increase the trade frequency. And keep in mind, this was a very simple test. ICT himself recommends trading short-term setups within the higher time frame trend, which we didn't fully incorporate in our testing. An experienced trader could likely enhance the results by aligning with that higher time frame bias, refining exits, or improving the risk-reward ratio by using lower time frames for precise entries. Now, I know what some of you are thinking, but Sam, I heard people say the strategy doesn't work at all. And you're right, the ICT community is split. Some traders swear by it, others claim it's complete nonsense. Here's my take after running the numbers. Even with a win rate as low as 27 to 28%, a solid risk-reward ratio can still yield profitability. That's basic maths. But position sizing, market context, risk management, these things will make or break your results. The problem I see with retail traders is they oversimplify these concepts. They think they can just mark some line, wait for a sweep, and print money. It doesn't work like that. This kind of honest, data-driven approach is exactly what we believe in at MarketMates. If you want to learn more about how to do this properly, head to the link below to our community where you'll learn all the nuance of doing this correctly from experienced traders. Thanks for watching, and I'll see you in the next one.